Okay, you are welcome to today's class. Okay, today we are going to be looking at um, statement of cash flow IAS 7, and it is a continuation class based on the last class we had under IAS 7. So I did tell you in that class that today we will be looking at how questions on IAS 7 can be solved. So we'll take a practical question today, and at the end of the class I will give you people assignment to go through it and see if you can make a good attempt on the questions that relates to statement of cash flow. Right, so I'll start by using about 10 minutes to read the question on statement of cash flow. Are we together? Good. So we have the question thus. We have Usman PLC, statement of profit or loss and other comprehensive income. Usman PLC, statement of profit or loss and other comprehensive income for the year ended 31st December 2013. So now we have revenue 1.6 million. We have interest income 10 million. We have gain on sale of plant. We have 8,000. Then we have expenses. You can see cost of sales. You can see wages and salaries, depreciation of plant and equipment, interest expenses, other expenses, profit before tax, income tax expenses, profit for the year, other comprehensive income. Then we have income gain on available for sale investment. Then we have income tax on that. Then we have total comprehensive income. So that's that. So we go on. Sorry for the interruption. Then we look at the statement of financial position, which is the balance sheet. So this is the statement of financial position. Now I will explain the tabular form for you to understand, so you won't go confused. So we have 31st December 2013. 31st December 2012. All right. Then we have increase or decrement as the case may be. Now listen. 31st December 2012 is the beginning of the year. We refer it to be the opening balances. Why the 31st December 2013 is the ending of the year. We refer to it as closing balances. All right. So if it is an increment, from 2012 to 2013, it will be positive. If it is a decrease, it will be negative. Mind that. But don't worry about the increase. Let's just look at the opening and closing balances of the statement of financial position. Now, cash at bank, account receivable, inventory, prepayment, interest receivable, plant and equipment, investment available for sale, then intangible assets. Now I will explain. I'll go back and explain. Cash at bank, the beginning value is 120,000. The ending value is 113,100 naira. You can see that it decreased. Account receivable, the beginning value is 140,000 and the ending value is 158,000. You can see that it increased. It's positive. Inventory, the beginning value is 130,000 and the ending value is 140,000. You can see that it increased. Prepayment, the beginning value is 16,000 and the ending value is 19,000. You can see that it's increased. Interest receivable, the beginning value is 300 and the ending value is 200. You can see that it decreased. Now in that order, continually till the end, which is intangible assets. Intangible asset, the beginning value is nil and the ending value is 30,000. Right, so these are the things we see here and you will definitely get to appreciate it. So move down to the other side of the balance sheet. Accounts payable, the beginning value is 84 and the ending value is 90. You can see that it increased. Wages and salaries, the beginning value is 8,000 and the ending value is 10,000. You can see that it increased. So we move down to accrue interest. The beginning value is nil and the ending value is 400. You can see that it increased by 400. Other expenses, the beginning value is 6,000 and the ending value is 36. You can see that it's decreased. This continued up to available for sale reserve. The beginning value is nil and the ending value is 28. So we have retained earnings and what have you. So these are that about this financial position. Now you should know and anticipate that they will always give you additional information. So it is time for us to look at additional information. It is not actually much, right? So we have additional information extracted from the company's record are additional information extracted from the company's records are plant which had a carrying amount of 20,000 was sold for 28,000 naira. Cash and new equipment was purchased for 100 million. So you can see that during the year we have transactions affecting plant and equipment. So we are going to make an adjustment to that at the workings, all right? The next is intangibles valued at 30 million naira. We are acquired for cash. Now you can see that during the year we made an acquisition of intangible assets to the value of 30 million naira and we bought this in cash, all right? Good. Now borrowings of 20 million were made during the year and received in cash. In that same year we borrowed money from bank and the value of the money we borrowed was 20 million naira, all right? Then the last but not the least there is dividend paid in cash amounted to 100 million naira, right? So in this year we paid a dividend of 100 million naira to our existing shareholders. Now that said, you are asked to prepare statement of cash flow for Usman PLC for the year ended 31st December 2013 in accordance with IAS 7 using direct method, all right? So we will commence operation immediately without waste of time, but I'm not actually after method, I'm after teaching you what you need to know. However, these are the solutions, explanation to the solutions profiled, but however, I'm after the working, so we'll go straight and look at the working of what we want to do. So the first working is interest paid. We have to adjust interest paid. How would you adjust interest paid? It is simple as anything you can imagine. Now we have the T form of account. The right hand side is the credit side, while the left hand side is the debit side. Now interest paid is an expense account, however is a liability. What makes it a liability? Let's go and look at interest in the balance sheet where we have the opening and ending value. Now you can see that here, this is liability side. You see accrued interest. The beginning value is nil and the ending value is what? 400. So the balance brought forward, since it is an accrual, accruals are liabilities, and all liabilities are meant to have credit balance. All right, since all liabilities are meant to have credit balance, accrued interest will have a credit balance brought forward. So if the credit balance brought forward is at the debit side, so at the credit side, that definitely means the balance carried forward, which is 400, will be at the debit side. So we'll move straight to what we actually want to do, which is this. So you can see balance brought forward is at the credit side. Balance brought forward is at the credit side, and it is new, just as we examined. And balance carried forward is 400. Now, during that year, in the statement of performance, that is statement of profit or loss, we paid interest. How much interest did we pay? So that is it. So we paid interest of 8,000 in the statement of profit or loss. So this 8,000 is in the statement of profit or loss. You can look that up in your WhatsApp to see if what I'm saying is true. then you add it. So 0 plus 8,000 will give you, close the account, will give you 8,000. Then 8,000 minus 400 will give you interest paid of 7,600. Do you understand? To give you interest paid of 7,600. This is how you adjust your interest. All right. So if interest is accruals, so it just is how you adjust it, depending on whether it is an asset or a liability, and the side where it is determines if it is an asset or a liability, as the case may be. All right. So move down to tax. Tax is a liability item. So balance brought forward of tax will be at the credit side. You can see it. So current tax and deferred tax, you see that in your balance sheet. You will see that in your balance sheet. So tax have this. So if the balance brought forward is here, that means the balance carry forward is going to be here. Look at it. The balance carry forward will be here. Then the tax you paid in the statement of profit or loss will be reflected here. So we have two taxes that we paid. We paid tax in SOPL and we paid tax in OCI. All right. So these two will be brought here. Then when you balance the account, it will give you tax paid of 50,000 naira. To give you a tax paid of 50,000 naira. I hope this makes sense to you. All right. Good. Now we'll move down to the next working, which is property, plant, and equipment. Now, if you can adjust this entry, this account, you have become a guru in statement of cash flow. Now, property, plant, and equipment is actually an asset account. Therefore, we have a debit balance. So that is why the balance brought forward is here. You can see it, and the balance brought forward is 3 million naira. So if the balance brought forward is here, the balance carried forward will be here also, and the value is 3,300,000. You will see this value in the balance sheet. You know where to see your property, plant, and equipment. So you gotta look out for it where you are supposed to say. All right, good. Now, if there is depreciation, and depreciation would always be seen, if not given out rightly, in the statement of profit or loss. So go to statement of profit or loss, you see your depreciation, you bring it here. It will be here. Always. If there was any disposal, the net book value of the asset disposed will be here. Remember, in the additional information too, they give us that we dispose an asset worth 20 million naira. So you bring it here. So this is where it is. Then you balance up. The difference between the two sides of this account will give you 10,000. So this 10,000 is acquisition of equipment. So it means during this year we acquired an asset worth 10 million naira. Please, our advice, have your note down. You can pause and play this stuff that you're watching. So as you jot down, you pause, you play, you pause, you play. You would understand better as you look at the questions. All right, your approach matters a lot. Good. So that is that for property, plants, and equipment. So we move to interest received. Interest received is an asset. Interest received is an asset. So being as an asset, what does that mean? It means it's going to have a debit balance. Being an asset, it means it's going to have a debit balance. Since it will have a debit balance, what do you do then? The balance brought forward will be at the debit side, and the balance carried forward will be at the credit side. You can see it here. This is the balance brought forward, and this is the balance carried forward. Is that understood? Now, if there was any interest we received, it will be here. So at this side. So since this is interest received, so the difference will give you 10,100 naira. So this is interest received balancing figure. So this is a cash of interest received, and you must know how to treat all these items in your cash flow. But we are not after that. We are after building you on the ability to understand how the workings are done. If you get your workings perfectly well, you definitely pass the exam. We move to intangible assets. Intangible assets is an asset now, so to have debit balance. I will take it again. All assets has debit balance. All liabilities has credit balance. So intangible asset is an asset. It will have a debit balance. So the balance brought forward will be here. All right, and the balance carried forward will be here. Now, the balance carry forward in the equation is 30 million. So that's why it is here. Then the difference between the two, or alternatively, we acquired intangible asset worth 30 million. That was what we were told. Was it not? Yes. So this is 30 million. So when you balance off, it will give you 30 million balance carry forward, and that is all. Then we have available for sale investment. Available for sale investment is easy. It's an asset now. Available for sale investment is an asset. So balance brought forward is 24,000. It's at the debit side. Balance carry forward is on the credit side. Then if there was any gain, the gain is 4,000, which is this. So you add up, it will give you the same value. So there was no disposal of balance of available for sale investments. So we'll move on. The last but not the least is dividend. So we have dividend paid. So how do you adjust dividend? You adjust dividend with your retained earning, but you don't need to do that because they told us already that dividend paid is 100 million naira, so no need adjusting that. So let's look at dividend paid so you understand what I'm talking about. So they told us that dividend paid in cash amounted to 100 million, so you don't need to adjust it. All right, so we'll move down to solution. Now in your solution, the first thing we are going to look at, we are done with workings now, is cash flow from operating activities. Now when I was writing my item, one of my secrets is cramming formats. I try as much as I can as a student to master the format given for every topic. So when I cram this format, it eases my brain and gives me a guide of what to do. For example, formats are just like compass that soldiers use to trace their way back to where they are going to. You understand? Compass helps you to identify and find your way towards your destination. That is what format does to students. So it is important and advisable that you cram formats. For me, it's the first point of thing you should do for you to yourself very well. So once you cram formats, you're good to go. You don't have any issue. All right. So the first thing that comes in is profit before tax. You go and look for profit before tax, bring it and write it there. The next thing that follows is series of adjustments. Now it is not incumbent on you to know what and what needs to be adjusted. In as much as you can identify what needs to be adjusted, you don't have any issue, right? So the first thing that needs to be adjusted is interest expenses. That needs to be adjusted. Now you go back. The interest expenses in your statement of profit or loss, you bring it in 8,000. Interest income, you add it. The interest income, you go and bring it in your statement of profit or loss, you bring it in, you less it. Let me reduce my speed. The first thing you do is to bring in your profit before tax. When you bring in your profit before tax, you now take care of your adjustments. Then if there was interest expenses, you bring it and add it back. If there was interest income, you bring it and less it. Now we want to remove those things that were deducted that were not supposed to be deducted in the profit or loss, and we want to also add back those things that were all right. So that is why we are bringing interest expenses. If expenses has been deducted in your statement of profit or loss, now we are bringing it back to remove it, to add it back to profit or loss, because it was not supposed to be deducted from profit or loss. The next item is interest income. This was added to profit or loss, so it wasn't supposed to be added, so we've now less it. So that is why these two were added and less. Depreciation was not supposed to be deducted because depreciation is a non-cash item, so we'll bring it in here and add it back. Gain on disposal is not supposed to be added in the profit or loss account, so we'll bring it here and less it. So when you do this, you now have this value. All right, so the next thing you do is to take care of your working capital. Now working capital is a very crucial topic and you must know. Now working capital is the totality of current assets and current liabilities, the difference between both. However, it's not all elements of working capital that we consider. The two most important elements that we don't consider are bank overdrafts and cash equivalents. We don't consider these two items, but the rest items are considered in your analysis of this column. So we now have account receivable. We have increase in account receivable. So it was 140 in 2012 and it was 158 in 2013. So it is what? An increase. An increment is an outflow of cash. So you had value of inventory of 140 at the beginning of the year, and you had 158 at the end of the year. This implies that you bought more assets, and you bought more stock. And buying more stock implies that a lot of money left. Understood? I'll take it again. The value of accounts receivable was 140 at the beginning of the year and now 158 at the end of the year. This implies that you bought more stock during the year, and buying more stock means a lot of cash left your accounts, bank accounts or cash. Alright, so same thing with inventory. It was 130 at the beginning of the year, 140. Prepayments 116.19 is also in. Now payables, you see, it was 84, it's now increased. So you were owing set of people 84,000 at the beginning of the year, and at the end of the year you are now owing 19,000. You're not owing 90,000. You are owing more now, and when you owe more, it means you collected cash from people that you're not giving them back. So it's an increment. That's why it's positive. All right. So this is how it is done. When you finish this analysis, you add up. You have cash generated from operation, which is this value. So the next thing you do is to take care of your interest paid. We didn't work in 1. Tax paid, we didn't work in 2, and that is cool. So these are payments now, you less them. So we now have this cash, net cash flow from operating activities. Understood? Good. So welcome back. So let's continue from where we stopped. So we'll now look at cash flow from investing activities. Now, if you want to actually treat this section, because the cash flow format is divided into 3 sections. So the first section is the one we just talked about, which is operating activities. So we want to now look at investing activities. And this investing activities deals with the fixed and intangible assets of the organization. So if there is any acquisition, any disposal, or any interest or dividend received from those investments, it will be recognized. They will be recognized here. So cash flow from investing activities, you can see it. Cash flow from investing activities. So we have acquisition of property, plant, and equipment, 100,000 naira. So we have number 2, proceed from disposal of property, plant, and equipment. So we sold plant and equipment, so that is the proceed that we got, 28,000 naira. So we have interest received. So interest received is 10,100 naira. We have acquisition of tangible assets, which is 30,000 naira. So we sum them up, it gives you 91,900 naira. So this is net cash flow from investing activities. So move to the last but not the least, which is cash flow from financing activities. So when we talk about cash flow from financing activities, we are looking at series of transactions that likely affects the equity fund and long-term debt of the organization. So the first item is increase in long-term borrowing. Now remember, the additional information told us that we borrowed money to the value of 20 million naira, which is this. All right. The next one is dividend paid in the additional information, which is 100 million. So that is all. So the difference between the both gives you 80,000 naira. So you now have decrease in cash and cash equivalent. So what do you do to get this decrease in cash and cash equivalent? What you need to do is to quietly sum up these items that are highlighted, so which are C, you can see A, B, C, B and A. So when you add them up, it gives you 6,900 naira in parentheses, which means depletion. So cash and cash equivalent brought forward, you see that in your balance sheet, 120, and that gives you cash and cash equivalent of 113,100. You can check it up in balance. So that is that for this. Now you can drop your question on the group chat. You can private chat me if you have any question, any challenge with respect to this question. We'll take much questions subsequently in our next class. All right, thank you for attending.